Hello, and welcome back to Boni's Life, your weekly dose of crypto clarity in a world of market madness. I'm your host, Boni, and this week we're navigating a sea of red, a flurry of fear, and a handful of opportunities that only a volatile market can provide. The crypto world has been on a roller coaster, and if you're feeling a bit queasy, don't worry. You're not alone. But as we always say here, chaos is a ladder, and for the prepared investor, it's a ladder to success. So grab your coffee, settle in, and let's dissect the week that was, and more importantly, the week that will be. We'll be diving deep into the technicals, unpacking the economic calendar, hearing from the big players, and of course, I'll be giving you my playbook for the week ahead. We have a lot to cover, so let's get started. First, let's get our hands dirty with the charts. The past week has been a brutal one for Bitcoin, with a 10.5% drop over 7 days and a staggering 22.7% loss over the last 30 days. We saw a high of over $94,000 just a week ago on November 17th, and a stomach-churning drop to a low of around $83,540 on November 22nd. Right now, we're hovering around the $85,800 mark, up a modest 1.7% in the last 24 hours. But don't let that small green candle fool you. The market is on a knife's edge. The key level I'm watching is between $82,000 and $85,000. This is a critical support zone, not just because it's a psychological barrier, but because it represents the average cost basis for many long-term holders. A definitive break below this level could trigger a new wave of selling, potentially taking us down to $78,000 or even $75,000. And if we break $75,000 on a high volume, well, that's when things could get really ugly, with some analysts warning of a move down to $60,000 to $65,000. On the upside, we need to see a convincing break above $90,000 to regain any semblance of bullish momentum. That's our resistance level. Break above that with volume exceeding $50 billion, and we could see a run toward $95,000, $100,000, and potentially back to $105,000. The Relative Strength Index, or RSI, is currently in oversold territory around 30, which could suggest a bounce is overdue. Historically, when RSI drops this low, we often see a relief rally within days. However, the MACD, another key momentum indicator, is still showing bearish signs with a negative crossover. The histogram is printing red bars, indicating continued downward pressure. Now, here's something concerning. We're potentially forming a head and shoulders pattern, a classic bearish reversal signal. The left shoulder formed around $109,000 in early October, the head at $126,000 in mid-October, and we may be completing the right shoulder now around $95,000. If the neckline at $75,000 breaks, the measured move could take us down to $30,000 to $35,000 in a worst-case scenario. Volume has been declining on the recent bounces, which is not a good sign. We want to see increasing volume on upward moves to confirm buyer conviction. The current 24-hour volume sits at $44.8 billion, which is below the recent average. Bitcoin dominance is at 56.8%, which means Bitcoin is still outperforming altcoins. When Bitcoin stabilizes or starts rising, we typically see money rotate into altcoins. But if Bitcoin breaks down, altcoins will likely suffer even more. So, what does this all mean? It means we're in a state of extreme fear, and the market is looking for direction. The bulls and bears are locked in a fierce battle at this $82,000 to $85,000 zone, and the next few days will be crucial in determining who wins. Now, let's zoom out from the charts and look at the bigger picture. The macroeconomic landscape is the chessboard on which crypto makes its moves, and this week is packed with key events. Think of it as the financial world's version of the Hunger Games. May the odds be ever in your favor. On Monday, November 24th, we have the German IFO Business Climate Index releasing at 9 a.m. UTC. The consensus is 88.5, a slight improvement from 88.4. Now, why should you care about a German business survey? Because a weak European economy could strengthen the US dollar, and a strong dollar often acts like kryptonite to Bitcoin. If the EFO comes in below 88, expect risk-off sentiment and potential selling pressure on crypto. If it beats expectations above 89, we could see some risk on buying. Later on Monday at 9 p.m. UTC, we get US consumer confidence, expected at 110. This is important because confident consumers spend money, which keeps the economy strong, which could mean the Fed keeps rates higher for longer. But Tuesday, November 25th, that's the main event. That's when things get real. At 1:30 p.m. UTC, we get two critical releases, US retail sales and the Producer Price Index, or PPI. These are high-impact events that could move the entire crypto market. Retail sales are expected to come in at plus 0.4% month over month. This will give us a clue about consumer strength heading into the holiday season. If these numbers come in hot, say plus 0.5% or higher, it signals that the economy is still running strong. And here's the kicker. A strong economy means the Federal Reserve is less likely to cut interest rates. In fact, the market is now pricing in only a 40% chance of a rate cut in December, down from 98% just a month ago. As Isaac Stell, an investment manager at Wealth Club, put it, instead of a perfectly wrapped rate cut for Christmas, the US consumer might get a lump of coal. And we all know who's on the naughty list when the Fed gets grumpy. That's right, risk assets like crypto. The PPI, which measures wholesale inflation, is expected at plus 0.3% month over month and plus 2.7% year over year. Higher than expected inflation means the Fed has to keep fighting it with higher rates. Lower than expected means they might have room to ease. My recommendation, reduce your position size by 30 to 50% before these releases. Wait for the initial volatility to settle, give it 5 to 10 minutes after the release, then trade in the direction of the data surprise. Also on Tuesday at 3 p.m. UTC, we get the Conference Board Consumer Confidence, expected to decline to 93.3 from 94.6. A bigger decline could signal economic concerns and short-term bearishness. Wednesday, November 26th, is pre-Thanksgiving positioning day. Expect low volume and light trading as US traders prepare for the holiday. Don't make any big moves on Wednesday. Thursday, November 27th, is Thanksgiving and US markets are closed. But here's the thing, crypto markets never close. And thin liquidity during holidays can lead to exaggerated price swings in either direction. This is high volatility risk territory, so I recommend reducing your positions to 30 to 50% of normal size. Friday, November 28th, is Black Friday, and historically crypto markets can be quite volatile due to continued thin liquidity. There might be day trading opportunities, but you need tight stops and quick reflexes. So there's your roadmap for the week. The key takeaway, Tuesday is make or break day. Strong economic data could send crypto lower, weak data could trigger a relief rally, and the rest of the week is a liquidity minefield. So, what are the big brains in the financial world saying about all this? Well, it's a mixed bag. With a healthy dose of caution, let's start with the bears. Tony Sycamore, a market analyst at IG, warns that if Bitcoin's slide is a barometer for overall risk sentiment, things could get really ugly. And he's not wrong. We've seen a flight from riskier assets across the board from tech stocks to crypto. The AI stock bubble is deflating, volatility is spiking, and investors are running for the exits. Brent Donnelly, president of Spectra Markets, points out the pro-cyclical nature of crypto treasury companies, who, in his words, buy high and are now selling low. These are companies like MicroStrategy that loaded up on Bitcoin when prices were much higher. MicroStrategy, the biggest Bitcoin treasury company, has seen its shares tank 61% since the July peak and is down nearly 40% year to date. If Bitcoin keeps falling, these companies may be forced to sell, creating a downward spiral. Donnelly also reminds us that 75 to 80% drawdowns have been part of the game in Bitcoin's history. In 2018 and 2022, we saw drops of this magnitude. If that pattern repeats from the $126,000 peak, we could see Bitcoin plunge to as low as $25,000. A sobering thought indeed. Alex Saunders from Citi notes that $80,000 would be an important level as it is around the average level of Bitcoin holdings in exchange-traded funds. This is why $80,000 to $82,000 is so critical. It's where many ETF investors are breaking even. And speaking of ETFs, we've seen 49,300 BTC flow out of Bitcoin ETFs recently, about 2% of total assets under management. These are the weak hands exiting. But it's not all doom and gloom. Let's hear from the bulls. A recent report from Van Eck, a major institutional player, offers a more nuanced view. They note that while mid-cycle holders are selling, the long-term whales, the OGs of Bitcoin, are still holding strong. In fact, the oldest wallets, those that haven't moved Bitcoin in over 10 years, have accumulated an additional 382,000 BTC over the past 2 years. That's a strong conviction signal. The selling is concentrated in the 3 to 5 year holder group, which has declined 32% over the past 2 years. These appear to be opportunistic cycle traders who bought in the previous bear market and are now taking profits. Meanwhile, the 10,000 to 100,000 BTC whale group has increased holdings by 3% over the last 30 days. This is the smart money accumulating during weakness. Van Eck also points out that the futures markets look washed out, with funding rates and open interest at oversold levels. Bitcoin futures open interest has been cut by 19% in just 12 hours during the recent sell-off, and it's down 32% in USD terms since early October. This kind of capitulation, combined with the fear and greed index hitting its lowest level since March 2025, could be a contrarian buy signal. So we have a classic tug of war between the short-term panic sellers and the long-term believers. The question is, which side will win? My take: the long-term fundamentals remain strong, but the short-term technicals are weak. We need to see Bitcoin hold $82,000 support and reclaim $90,000 resistance before we can call a bottom. All right, so that's the what. Now for the so what. How do we trade this market? As always, this is not financial advice, but I'll share how I'm thinking about the week ahead. I've prepared 7 different strategies for different risk profiles. Let's go through them. Strategy number 1, range trading for conservative traders. The assumption here is that Bitcoin consolidates between $75,000 and $92,000 for the next week as the market digests the recent sell-off. Your buy zone is $78,000 to $82,000. Scale in with 3 equal entries within this zone. Don't go all in at once. Your sell zone is $88,000 to $92,000. Scale out with 3 equal exits. Use a stop loss at $74,500 for long positions. Only allocate 20 to 30% of your trading capital to this strategy. The risk reward is about 1 to 1.5, which is acceptable for a range-bound market. Strategy number 2, breakout chart breakdown trading for aggressive traders. This is for those who want to trade the big moves. For a bullish breakout, wait for a daily close above $90,000 with volume exceeding $50 billion. Then enter on a retest around $90,500 to $91,000. Your targets are $95,000, $100,000, and $105,000. Stop loss at $87,500. For a bearish breakdown, wait for a daily close below $80,000 with high volume. Enter on a retest around $79,000 to $79,500. Your targets are $75,000, $70,000, and $65,000. Stop loss at $82,500. Make sure you get confirmation from RSI, MACD, and volume before entering. Don't jump the gun. Strategy number 3, dollar cost averaging for long-term investors. This is my favorite strategy for those who believe in Bitcoin's long-term future. Every Monday, purchase a fixed dollar amount, anywhere from $500 to $5,000 depending on your portfolio size. Allocate 50% to Bitcoin, 30% to Ethereum, 10% to Solana, and 10% to XRP. If the price drops below $75,000, double your allocation for that week. The time frame is 6 to 12 months minimum. Don't sell until Bitcoin reclaims $120,000 or just hold for 2 to 4 years regardless of price. This strategy has worked in every previous cycle. Strategy number 4, event-driven trading for active traders. This is all about trading the economic data releases, especially Tuesday's retail sales and PPI. Rule number 1, reduce position size 30 minutes before major data releases. Rule number 2, wait 5 to 10 minutes after the release for initial volatility to settle. Rule number 3, trade in the direction of the data surprise. If retail sales beat expectations, that's potentially hawkish Fed equals sell crypto. If they miss, that's potentially dovish Fed equals buy crypto. Rule number 4. Use tight stops of 2 to 3% due to event volatility. Rule number 5. Take quick profits of 3 to 5% within 4 to 8 hours. Strategy number 5. Altcoin rotation for diversified traders. Bitcoin dominance at 56.8% suggests altcoins are underperforming. If Bitcoin stabilizes, altcoins could outperform. Top pick number 1. Ethereum at $2,798. The Fusaka upgrade is coming on December 3rd, which could be a catalyst. Entry zone $2,700 to $2,800. Target $3,200 to $3,500. Stop $2,550. Allocate 40% of your altcoin portfolio here. Top pick number 2, Solana at $129. Strong developer activity and meme coin ecosystem. Entry $125 to $135. Target $155 to $175. Stop $118. Allocate 25%. Top pick number 3, XRP at $2.03. The ISO 2022 migration happened on November 22nd. Plus regulatory clarity. Entry $1.95 to $2.10. Target $2.50 to $2.80. Stop $1.85. Allocate 20%. But here's the critical part. Only rotate into altcoins if Bitcoin holds $82,000 support. If Bitcoin breaks $80,000, exit all altcoin positions immediately. Altcoins are 2 to 3 times more volatile than Bitcoin. Strategy number 6. Hedging for risk management. If you're holding Bitcoin and want to protect against downside, you have 3 options. Option 1. Open a short position on Bitcoin futures equal to 50% of your spot holdings. This protects against downside while maintaining upside exposure. Option 2. Buy $80,000 strike put options expiring December 27th. This gives you insurance below $80,000. Option 3. Convert 30 to 50% of your portfolio to stablecoins like USDT or USDC. This reduces risk and gives you dry powder to buy back lower. If you're in cash waiting to enter, use laddered buy orders. 20% at $85,000, 20% at $82,000, 20% at $78,000, 20% at $75,000, and 20% at $70,000. Strategy number 7. Scalping for advanced traders only. This is high-frequency trading on 5-minute to 1-hour charts. Trade during US market hours, 1400 to 2200 UTC, when volume is highest. Use 3 to 5 times leverage maximum with very tight stop losses of 0.5 to 1%. Key levels for scalping: support at $85,000, $84,000, $83,000, $82,000, resistance at $86,000, $87,000, $88,000, $89,000. Target 1 to 2% per trade. Aim for 5 to 10 trades per day and targeting 10 to 15% weekly return, but never risk more than 1% per trade and stop trading after 3 consecutive losses. No matter which strategy you choose, risk management is paramount. Never invest more than you can afford to lose. Always use stop losses, accept losses quickly, and let winners run. And most importantly, stick to your plan. Don't let emotions drive your decisions. Let me give you my specific playbook for each day this week. Monday, Tuesday. Focus on event-driven trading around the economic data. My bias is slightly bearish due to strong US data expectations. Reduce positions before Tuesday 1:30 p.m. UTC data releases. Be ready to act quickly after the numbers drop. Wednesday, pre-Thanksgiving positioning. Expect low volume and potential short covering. My bias is neutral to slightly bullish. Keep trading light and prepare for holiday volatility. Thursday, Thanksgiving Day. US markets closed, but crypto never sleeps. High volatility risk due to thin liquidity. Reduce positions to 30 to 50% of normal size. Don't try to be a hero on Thanksgiving. Friday, Black Friday, and post-Thanksgiving trading, unpredictable and could swing either way. There are scalping opportunities, but you need tight stops and quick reflexes. Not for beginners. Weekend. Review the week's price action and adjust your strategy for the following week. If we held $82,000 support, that's bullish. If we broke below, that's bearish, and you need to reassess. Remember the critical levels: $82,000 to $85,000 is support, $88,000 to $90,000 is resistance, $75,000 is the line in the sand. Break below that on high volume, and we're in serious trouble. So, there you have it. A market in turmoil, a nervous economic backdrop, and a battle between fear and greed. The week ahead will be a test of conviction for every crypto investor. Will the bulls hold the line at $82,000? Or will the bears finally break through and send us into a deeper correction? Only time will tell. But one thing is for sure, we'll be here to navigate it with you, whether you're a conservative DCA investor, an aggressive breakout trader, or somewhere in between. There's a strategy for you in this market. The key is to stay disciplined, manage your risk, and don't let fear or greed control your decisions. Markets are cyclical. Bear markets create millionaires, bull markets create legends. And right now, we might be in that accumulation phase that you'll look back on in 2 years and wish you had bought more. Remember, Bitcoin has been declared dead hundreds of times. It survived 75 to 80% drawdowns before. The technology is stronger than ever, institutional adoption is growing, and the long-term whales are accumulating. These are all positive long-term signals. But in the short term, we need to see Bitcoin reclaim $90,000 and hold it as support before we can confidently call a bottom. Until then, trade carefully, size your positions appropriately, and always have a plan. Thanks for tuning in to Boni's Life. If you found this analysis valuable, please hit that like button, subscribe to the channel, and smash that notification bell so you don't miss a single update. Your support means the world to me and helps me continue bringing you this content every week. Remember, this is not financial advice. Always do your own research and never invest more than you can afford to lose. I'm sharing my analysis and strategies, but you are responsible for your own trading decisions. And next week, we'll be covering the aftermath of this critical week, analyzing how the market responded to the economic data, and looking ahead to December, historically one of the most volatile months for crypto. Stay safe, stay informed, and stay profitable. I'll see you next week. This is Boni signing off.